Today I want to contrast two competing views of the economy and the stock market. One is from the financial establishment. This view is from those within the investment industry. They tend to be more inward focused and have an investing philosophy that supports people always being fully invested. Their philosophy supports their belief in always buying some combination of stocks and bonds, no matter how poorly the outlook of stocks and no matter how poorly the outlook of bonds may be. This group is made up of those within brokerage firms, big banks, and even most typical financial advisors or financial planners. The other view is from those who take a more independent view. These people are usually not tied to institutions or the establishment. They understand that there are times to be invested and there are times where market risk is to be avoided. In periods of higher risk, they remove money from riskier equity-based assets. They understand that the market goes through cycles. They make money at times and preserve money at other times by taking advantage of these cycles. This group is made up of independent thinkers and those who are not beholden to large institutions or the establishment. Those from the establishment make up about 90% of the industry. They are everywhere, and establishment-type thinking tends to dominate the investing landscape. However, those who truly want to avoid or minimize deep risk and prolonged losses use investing methods that are more risk-averse. I will feature the thinking of those who are outsiders and who are more independent in their thinking. Hence the use of Michael Burry. I'm Ben Reppond. Today is May 24th, 2022. Welcome to my YouTube channel. Abby Joseph Cohen is the Global Chief Investment Strategist for Goldman Sachs. She's the final voice in the decisions of where they go as a firm and how they advise their clients. A very important position. When she was on CNBC in December of 2007, they interviewed her and asked her view of the coming year, 2008. She said the S&P 500 should climb 14%. Climb 14% in 2008. And as you probably know, it collapsed 36% and actually went down about 56% from its high in October to its low in March of 2009. That reminds me of when I sold my company and got the final payment from my company for the company in October of 2007. I had money to invest, and I was outside the industry, didn't know anything more than the average person knows about the stock market or investing. And I went to 4 firms, national, big name banks, brokerage firms, and with people with impressive credentials and manage a lot of money, etc. And I thought, I'm going to get the best advice from these kinds of people. And they all gave me about the same advice. Each one was a little different, but they were close. And they all basically said in October of 2007, just put your money in the stock market. the proposals were impressive and fancy, but really it came down to you're just investing in the stock market. And I rejected all of them, not because I was smarter than they are or anything like that. It was more just a gut feel that I felt like it was too risky. So I backed away and put my money in money market, and I did nothing. From that day forward, I saw the market absolutely collapse. And then what I did after that is another story, and I'll explain that at another time. 2007, 2008, the stage was set there from my experience back in 2000. Because in 2000, I had sold another company and had money to invest. And I thought I knew what I was doing, and I did not. I did all the wrong things, and I lost a lot of money. And it was very disheartening. So anyone who invests in the stock market, if you use an advisor or if you do it yourself and you lose a lot of money, no matter how it happens, I know what that feeling is like. But that made me much more cautious. And so when it played out in 2007, this was about 7 years later, when it played out then, I realized that I was just more cautious about it, and that's why I think I backed away from those recommendations. Abby Joseph Cohen is not, I'm not picking on her or Goldman Sachs necessarily. She and they represent the industry. The industry teaches that one should just be invested in the stock market. And if that's too risky, which often it is, they recommend bonds. And so they don't ever recommend changing that allocation usually. And people are they're told to just write it out, write it all the way down, write it back up. And they don't use the word all the way down. They say words like, we didn't see this coming, you have to invest for the long run, and you can't sell now, things like that. But the reality is you and I, the investors, we are caught in this trap of conventional thinking, which basically does mean you do write it all the way down, and how far down that is, those are your losses, and you will never get that money back. You can make new money, but you won't get that money back. Getting it back requires an entirely different strategy, and they don't teach the idea of getting out of the way, and they don't teach the idea of using a different strategy to get it back. This reminds me of a quote which I've given before from Med Jones. It precisely fits here. So I want you to think about what Abby Joseph Cohen said, the industry that she represents, that kind of thinking, including the typical financial advisor and financial planner. As I read you the quote from Med Jones, there are two main reasons, and he wrote this after 2008. And by the way, he got it right. He called it, and he's not even an investment person. He's an economist and a think tank leader. But he does manage his own portfolio. I'm acquainted with him, so I know about what he has done. And he got it right both before the market crash and then in going back into the market, because he was looking at different indicators than those who are within the industry. He is an outsider. There are two main reasons that caused mainstream economists and financial media to miss the financial crisis of 2008. The first is NIH, not invented here bias, which is an organizational phenomenon manifested as an unwillingness to adopt an idea because it originates from unknown outsiders. It is a form of social cognition bias that leads to errors in group judgments, such as missing on new opportunities or risks. The second reason is a cognition bias known as the confirmation bias, which is the tendency to search for, filter in, or interpret information in a way that confirms existing preconceptions. The confirmation bias is recognized as an individual cognition bias, but when met with NIH bias, appears to develop into a social bias very similar to the groupthink syndrome. I contrast Abby Joseph Cohen and her quote, and the industry of traditional thinking, with Michael Burry, whose life was portrayed in The Big Short. And he says this today, and we know how he called it. If you watch the film, you know how he called it in 2007, even 2006. And I'll just give a brief background on this. In 2006, he was an investment hedge fund manager, not a big fund, a small fund in New York. And he did independent research. He did not buy what the industry was selling. So in his doing independent research, as the movie portrays, he was absolutely convinced that the U.S. in particular was in a housing bubble, and credit had been extended where it should not have been extended, and that loans were taken out that should not have been taken out, etc., and the whole thing was going to collapse. His research led him to that conclusion. The more he researched and more he researched, trying to see, am I missing something? Because he was hearing the alternative voices, which was mainstream financial people, were saying, no, it's going up, it's not going to crash. And his data was saying exactly the opposite. Now, he's an independent thinker. So he went back to the data. The film portrays he became more and more and more convinced. He even lost clients. I think quite a few clients who gave up on him. And he was shorting the market, which is a scary bet. But because they were losing money, the market is going up. They're short the market, which means their accounts basically are going down while the market's going up. And this continued for about a year to year and a half after he took the short position. But he was absolutely convinced he was right, stayed with his convictions, and those who had stayed with him were richly rewarded. He says this today: everyone is lying. A bigger crash is coming. He is predicting a 56% drop in the stock market. I want to show you people who I follow, who have followed for several years, who are independent thinkers, and what they are saying today. And one of those people, colorful personality, is Jim Rogers. And his track record speaks for itself. He's made lots of people lots of billions of dollars over the years. And then he retired with his own pot full of money, I guess. And he called the 2000 crisis correct as a bubble. He called the 2008 crisis correct. And like Michael Burry, he shorted home builders and financial stocks in around 2007-ish. I don't know the date. But he is on record as having said that. He says today, the biggest market crash in our lifetimes is coming. The biggest market crash in our lifetimes. He's 79, so I guess this goes back quite a ways. What's interesting about him is when he got out of college in the mid-60s, he went to work on Wall Street for a brokerage firm, and he just had this intuition about things. And he tended to be a little bit of a contrarian, and so he saw they were being told, sell this stock, sell this stock, sell this stock. Well, back then, I think the brokerage firms were actually buying stock and then asking their brokers to go sell it so they could unload it off their books. It was kind of not a good situation, but his colleagues were out there selling stocks, hyping the market, and he kept thinking to himself, this thing is this is garbage. These things are overvalued and I can't sell this. So I eventually left and started a hedge fund, etc. But if you follow the late 60s, early 70s, you saw what happened. And then later on, it manifested itself again in the late 70s. This next person is Jim Rickards. Jim Rickards is an author, speaker, lawyer, economist, independent thinker, completely independent, not tied to Wall Street at all. And I've read his books. They're an influence to me and my thinking. And he's a prolific person interviewed on YouTube. You can put his name in, you'll get a lot of interviews. And interesting personality and very smart. He says this: most people have no idea what is going on. The big collapse is coming. A week or two ago, I featured Jeremy Grantham, who is the co-founder of his investment firm in Boston. And he's 83 years old. He's been doing this for many decades. He is regarded as an independent thinker and a person with a lot of insights. He also has made predictions prior to 2000 and 2008. And he has a method to deal with that. Given the amount of money that he manages, he has a way to diminish the risk to his investors when he sees that coming. He says this: the Fed cannot stop a market crash this time. This will be the worst since 1929 and 2000. Now, when he says that, I think he's looking out not just for the next few months or this year or maybe even next year. He's looking, I think, over the next few years. So it's a little more of a macro view, but he believes, based on all of his experience and data that he looks at, that we are truly headed for a steep market crash, not just a correction. Stanley Druckenmiller is a hedge fund manager and has been immensely successful over the years, and he now just manages his own money. But he said recently, this is the biggest bubble I have ever seen. He reminds me of another hedge fund manager, Paul Tudor Jones. And what makes Paul Tudor Jones unique and how he got his reputation is in 1987, he predicted that the market was going to crash, and he shorted the market. In October of 1987. It is reported that he made his clients and himself collectively $100 million on that fateful day in October 1987. And hence he gained national prominence and has been interviewed frequently on CNBC. He says this: the market fools 99.9% of the people. And I think that includes traditional financial advisors and even the financial advising community. He goes on to say, we're going to have another crash like 1987. And he speaks from experience. The stock market will crash, according to Steve Forbes. The stock market will crash. Inflation is coming. He said that about a year ago in 2021. He did not know what was going to happen in early 2022 exactly, but he could see the indicators were so obvious that it's got to happen, and sure enough, it did happen. And what's interesting is he also predicted inflation, high inflation, is coming, because he could see, and I said this last year as well, that with the amount of printed money, it has got excess printed money, it has got to result in crazy high inflation. Before that started to happen 6 to 8 months ago, you could see it coming. And it was not being reported. And here we are. Scott Meinard is the Global Chief Investment Officer of Guggenheim Funds and manages one of their strategies and has a track record of calling tops and bottoms of markets. And he manages his fund that way. In his fund category, he is the #1 mutual fund manager in the U.S. and has been for about 10 years straight. What does he know and how does he know it that is different than all of the other experienced and educated people in his field? I don't know. That's his secret sauce. But he is definitely has an amazing track record and is highly regarded in the investment industry. He predicts a recession next year, 2023, and that stocks could go back down to 2007 levels. That's 15 years of gains in the stock market that would be wiped out in portfolios. I have never known him to make a prediction that has not been correct. I listen to David McIlvaney's podcast each week, actually each Wednesday, and enjoy it. It's full of information, and he is a considered economist, thinker, writer, speaker, and he said he predicted last year a collapse in stocks and bonds and increasing levels of high inflation. He has been right on all three. An outsider, Willem Middlecoop, author, thinker, independent thinker, person who's actually, I highly recommend his book, The Big Reset. It's full of information. It was written about 8 years ago, and it's as if it was written last month. It precisely applies to everything that we're dealing with today. I don't know how he knew all of this 8 years ago, but maybe I think some of it's because he is an outsider and independent thinker and not part of the industry machine. He said recently, "These are scary times. We are on the verge of collapse." Harry Dent, prolific writer and speaker and economist, and he says that, and sometimes I'll admit, he does speak in hyperbole, and I sometimes just have to take a little bit of what he says with a grain of salt, but he's also been right in the past as well. So he says the biggest stock market crash in our lifetime is coming, very similar to what Jim Rogers said. And he is predicting a massive drop in stock prices. And finally, Warren Buffett. While he is accomplished, he is probably the biggest or one of the biggest names in the investing industry and has a unique style. He does things a certain way, but his sense of humor and his direct way of speaking is appealing, and a lot of us like to listen to him. And a couple of years ago in his report to shareholders, at the end of the year, he said, "Get ready to lose half your money." He knows this because he's seen this before, not unlike Jeremy Grantham. He has, in the article that I read about him and this story, showed the picture of how he has lost half of his money 4 times, going all the way back to the early 70s, half. And they showed exactly how much he lost each time. The average was about 50%. So when he says this, he says it from experience. But yet, the reason I'm saying this is to point out that the industry, like Abby Joseph Cohen so well portrayed, the industry just says, invest your money, invest your money. And they don't think, they're not taught to think of how to get out of the way. They don't believe in that methodology at all. They just believe in just put your money in and it's going to be okay in the long run. You might be in your 70s or 80s, but they still tell you to invest for the long run. I understand if you're in your 30s or 20s, yeah, that's a fair statement. Invest in for the long run. But when you use that phrase on everybody, it somehow loses its appeal. Speaking of Warren Buffett, I've shown this before, and I want to show you the Buffett Indicator. This is what he has used in the past as a method of determining where the market is in terms of value. He has accumulated and is sitting on, the last I read, about $120 billion in cash. Why? Because he is waiting for an opportunity to buy that's better than today. So when he looks at this chart and can see historically, this goes back to 1950, you can see historically there are high points where you just don't want to be invested at those points. You want to wait until you can get a more favorable price for the assets you're looking to acquire. And so if you look at this chart and to the right, I drew a red arrow going down. I would think this has got, even though we look at the losses we've had in the stock market and the bond market, and look how far the ratio has fallen. The ratio is corporate equity prices relative to GDP, gross domestic product. So that's basically the economy. So you could say it's the stock market divided by the economy. Why that? Well, the reason for that ratio is that the economy should support the prices of the stock market in general, in a macro way. So he puts it in the form of a ratio and then plots the ratio. And then with a regression line drawn through the middle, you can see how far this ratio has got to fall, how the value of stocks has got to fall relative to the economy in order to get back to the regression line. And when it comes down to the regression line, it doesn't tend to stop there. It tends to go past it and go on down below that, which is where asset prices become very attractive. I want to shift gears and think about the economy. And one of the things about the economy that's having an effect, that's creating challenges in our economy, is the supply chain. The supply chain is affected. Now, we get most of our goods. I'm not referring to energy and commodities. I'm just saying most of our goods that are manufactured come out of China. That's true for most of the rest of the world. They get their goods, they purchase them out of China. So this is a picture. It's an aerial view, satellite view of the port of Long Beach. And the ports of Long Beach and Los Angeles are the primary ports that ships come into from China to unload and then be shipped around the country. This was over 100. I think it was about 6 months ago. I showed a picture of it, aerial view. About 100 ships were outside the harbor in Long Beach. I think I counted correctly. There are about 35 right now. So the backlog of shipping containers, cargo ships from China to the U.S., and I'm using Long Beach as a primary example, has diminished quite a bit. So they've worked through the backlog, or a lot of it. They always expect some kind of backlog. But it now there is not much of a backlog, and whatever comes in is being shipped unloaded and shipped out fairly quickly. Contrast that with what's going on in China. This is China. This is a satellite view of what's going on outside of the ports in China. I look at that and I see thousands of ships. Some of them, there are so many of them, the dots are blurred into just a bigger dot. You can obviously see that there is a huge backlog. This is from the supply side, from the side of the equation, the manufacturing part in China before they're shipped. We can't get them distributed to the retailers for people to buy those goods unless they're shipped out of China. So yes, there is a problem in the US, there's a problem all over the world, and there is a problem in China. Theirs is the supply side, ours is the demand side. Why is this? Well, Shanghai still has 25 million people in lockdown. Beijing is in lockdown. I've read there are hundreds of millions of people throughout China who are locked into their homes or apartments, locked in from the outside. It has been over a month since they've done the lockdown. I know that people are starving, and I don't know how many people have died. I don't know if there's any way to know because they're locked in. I showed a picture a few weeks ago, a video clip of people in Shanghai who were yelling, screaming from their apartment balconies, "Help, I'm starving." They're screaming, "Help, I'm starving." That was several weeks ago. And if they're locked in, they're locked in. So those people work somewhere. Some of them work at the ports. And so there are not enough workers at the ports to load the ships. There's a complete breakdown. And then there's truckers who won't go into the cities because they're afraid of being locked down. So this is a problem throughout the world. But as I saw this, I thought of all of the areas in our economy that are broken, that I know that the economy and the stock market sometimes move together. And as I pointed out, sometimes they move in opposite directions and then they trade places. So I'm not saying the economy is always a direct reflection, or the market is always a direct reflection of the economy, but I am saying that at some point, if the economy comes down far enough and hard enough, this will have an impact on stocks. I read something today or yesterday that said the manufacturing in China, in Shanghai, has dropped 62% in the last year. They're producing 62% less goods in Shanghai today. This has a huge effect on the US and the world economy. I wrote these down. I just thought of 17 areas in our economy that I looked at each one of them. I couldn't find a single one of them that wasn't really in serious trouble. And they are, and I just run through these real briefly with you. For example, empty baby formula shelves. Baby formula. Babies are crying, starving. Mothers are going crazy trying to find food for their children. Feared summer power blackouts. I don't know a lot about that, but I understand that that is a concern that will hit us this summer. Plunging stocks and bonds. When has that happened? You have to go back, I think, to the 1970s to find when we had an environment like that. A prediction of $6 a gallon gas, and by the way, in California, $8 a gallon gas. Fear of a serious recession. We're 1 month away, less than a month away from this being that recession. Why? It takes 2 consecutive quarters of contraction to be called officially a recession. We had a 1.7% decline in the first quarter, quarter one. What will happen in quarter two? If it is negative, we are officially in a recession. Coming food shortages, not just baby formula, but in every area. I think because the Ukraine, they were not able to plant their crops this spring, and they provide a lot of food for the rest of the world, wheat, corn, soy. This coming fall, it is expected that we will have shortages, severe shortages throughout the world. Soaring grocery prices, again, because of food shortages. Soaring grocery prices, you know this. You check out and can't believe the price that you're paying. Now we're hearing about monkeypox. Monkeypox is on the way and seems to be expanded rapidly. We don't know what that's going to mean, but it's not good news. Increasing crime everywhere, even in smaller towns. Continuing war in Ukraine doesn't seem to be letting up. It may be old news now, but it's still going on. A weakened military. 30 trillion in debt. And with an annual contribution to that debt of about $3 trillion this year. Not only are we increasing the amount of debt, the spending, which is out of control, and adding to the debt, now the interest rates have gone up, and we, as a country, we pay interest on our debt, and so we are paying higher and higher rates of interest and causing that 30 trillion to go up faster and faster. The Federal Reserve has printed $9 trillion of paper money, nothing behind it, digits. I call it phony money because there's nothing behind it. It's only worth something if you and I agree that it's worth something. It has no intrinsic value, and nothing behind it has increasing intrinsic value. So the amount of gold that we have in Fort Knox and New York and other places, that was not increased when this 9 trillion came into being. They just printed or digits. 5 million of the 9 is new printed money, new in the last 2 years. 5 trillion of new money in the last 2 years, nothing behind it. And then look at the debt, which again is just kind of like printed money, is 3 trillion a year of debt on top of the 5 trillion in the last 2 years. My math tells me that's probably over about, rough math is probably over about $10 trillion of money in the system with nothing behind it. This is not going to end well. Out of control inflation. I read this morning that the UK is up to a 10% level of inflation. That's, of course, ours is not 8.5 or 8.3. It's around 16 when you put everything back in. But using their number for consumer price index, let's call it 8.3. Comparatively, the UK is at 10. Rapidly increasing interest rates, and that's showing up in mortgage rates. And mortgage rates is significantly impacting a slowdown in the real estate market. I believe if all of this plays out, it may take a year or 2 or 3, that we're going to end up with a collapsed real estate market in addition to the collapsed stock market and bond market. Culture wars, right versus left, family members being alienated from each other in a way that I don't remember that in the past. Coming riots from the overturning of Roe versus Wade. That's a prediction by some, but if that happens, that won't go well either. So you put that as a backdrop on top of everything else. Everywhere I looked, I couldn't find any good news. It was all negative. So I'm just reporting what I see. Global View Capital is a firm that we do business with. We manage money, a small amount of money on their platform. We have been there for 3 years. They have had us in incubation, watching us, watching our performance. They call it incubation, while they wait to see if our historical back test and our model actually plays out the way that it is modeled. We have had 3 successful years of performance and have met their expectations. And as of July, they tell us that they're going to put us as a solo manager on their platform. Right now, we're on there with a collection of other managers, but we will be a solo manager in July, and we're very proud of that. And this last month, they illustrated the performance of their managers. I think they have over 100 strategies on their platform. I don't know the exact number, but it's over 100. And we were ranked number 3 for the last year. The 2 that were ahead of us were gold and hard assets. So when really compared to those that are equity-based strategies, we would have been the number 1 manager on that platform. Now, I don't say that to talk about performance. I say that to talk about risk management, because the reason we're number 1 is not because we took more risk, but because we took less risk. We have greatly reduced the amount of risk that we take this year, and that has helped our performance from 2021. When we had good performance, it's helped us retain a lot of that performance. And so when the entire year is looked at, the last 12 months is looked at, it has made us look extremely favorable, and we're pleased about that. But we're especially pleased about the validation of our approach, that we are in fact managing downside risk. And that is the first thing we want to do more than anything else. I believe that if we manage downside risk well, the upside will take care of itself. Now I want to get into some data, and this is as of Friday. So this is just a dashboard to show you what's going on in the market. So here we have, they're all U.S. assets. Year to date, the Dow down 14%, S&P 500 down 18%. The long-term government bond, TLT, is down 20%. No protection for equity assets. The NASDAQ 100 down 27%. The technology sector of the NASDAQ 100 down 30%. And the ARK-K Innovation Fund down 55%. When I take this is a dashboard showing on the far right side dots. And these dots represent a very simple yes or no question. The yes or no question is, are these indexes, these averages above, or these indexes above or below their 20, 50, 100, and 200-day moving averages? These represent the Dow Jones Industrial Average, the S&P 500, the NASDAQ 100, and the Russell 2000 Small Cap Index. And then the 2 foreign indexes, EFA for developed markets and EEM for underdeveloped markets. In every case, except one, they get a red dot, meaning they are below their moving averages. In only one instance, and that is the developed markets, foreign markets is above one of its moving averages. So out of 26 chances to be positive, we get one green dot. We are definitely still in a bear market. That has not changed. Whether the market goes down today or up today, we are still in a bear market. It will take more than this to move us into positive territory. And I would love for us to be positive territory. I would love for all or most of these to be green. Who of us would not? That's where there's opportunity to make money. But now we're not in that season. We're in a season of preservation. At least that's the way I see it. When you take the S&P 500, it is comprised of 11 sectors, industry sectors. And they're everything from technology, telecommunication, utilities, retail, industrials, etc. You take all 11 of those, one of them is above its 20, 50, and 100-day and 200-day moving averages. One. The other 10 are below all of their moving averages. The one that's above is energy. No surprise. And all of the others are negative. That 4 is contrasted with 7 last week. Now I'm going to show you some charts. This just shows you, gives you a macro picture. This is a 12-month view, weekly chart. And it shows that for about 7 or 8 months, the S&P 500 was on an upward trajectory. And for the last 5 to 5.5 months, it has been, 4 to 5 months, it has been in a downward trajectory. And you see at the end of this chart, you can see the line and you can see the sharpness of the decline for the past couple of months. It's down quite a bit. I contrast, I do a ratio of one over the other, the ratio of growth versus value. And that's represented by SPY-G for growth and SPY-V for value. And it's a 12-month weekly chart. And you can see, generally speaking, for the first 6 months approximately, for maybe 5 or 6 months, for that growth was in favor. Growth outperformed value because it went up, numerator, denominator. In the past 6+ months, it's been the opposite. Look at how value has dominated growth. Value it's not going up, it's going down, but it is going down at a slower rate than growth. Growth is accelerating on the way down, which makes it exaggerated on this chart. And again, you can see the end of that chart, much like the last chart, definitely pointed down. Growth is definitely out of favor at this time. Small cap, represented by the Russell 2000 Small Cap Index, IWM, numerator, relative to the S&P 500, SPY, denominator. That ratio is showing that small cap has been out of favor for a year or longer. This was actually a 14-month chart. So SPY has been performing better than the small cap index for 14 months. Now, at the very end of the chart, I don't know that this is a trend, but I thought I'd just try to give you some good news. At the end of the chart, it has ticked up. It is starting to go back up. So maybe, we don't know, but maybe the small cap index will start to get a break here at some point. And maybe it will go up in a way that's greater than the S&P. I know at some point it will. We just don't know if this is one of those times. And then I look at the 24-month chart for the long-term government bond, TLT, 24-month chart, it's a weekly chart. And I draw 2 arrows, the red arrow showing one period where it went down, and then the second period is a more recent period. And then you can see at the very end of the chart, like last week, it actually started to go back up some. So is that going to stick? I don't know. But it's maybe something positive. We got out of the market over a year ago, 15 months ago, somewhere in that decline of the red line. And I could see that time that the bonds were just not going to be the answer for stock risk. So we pulled that completely out of our model. And so for the last 15 months or so, we have nothing to do with bonds in our model. It's either equities, value or growth, or cash. I put this chart, this is a 24-month chart on gold represented by ETF GLD, and I put a red line right through, kind of a mean. The mean is somewhere around the red line. And it looks to me like it just goes up and down a lot. So, right now it's down a little bit. It was up last week, but, it does not reflect the demand for gold. The demand for gold and silver is incredibly high, and you can tell that by the markup that you have to pay on a retail level. The spot price is manipulated. Silver, represented by SOV, I did the same thing. A little bit different chart, goes up and down quite a bit, but it still looks similar. It's still, with a recent pullback in silver, even though it was up last week, it's still in not a decisive pattern. Then I do a ratio between silver and gold. Silver being numerator, gold being denominator. So when it goes up, that means silver is in favor, which it was for about, 8 or 9 months last year. And then gold came into favor. And so on a relative basis, gold is outperforming silver, or you could say the black line represents silver underperforming gold during that 24-month period. And then volatility. This is the volatility index for the last year, showing the VIX, VIX, for a measurement of volatility and risk. And you can see through last week that volatility is still elevated. And over the past year, the general trend is elevated. Each week I show the metrics from Asbury Research, and this is their Asbury 6. You can see that all 6 of their metrics are negative, meaning we're clearly in negative territory as far as the market goes. No surprise. This is their cross-asset protection model. There are only 3 of their relative strength metrics which are consistently positive for the weekly, monthly, and quarterly views. And I mark those by a red arrow on the left. Those are, when you compare the U.S. versus developed markets, the developed markets are outperforming the U.S. And you saw that in a previous chart where I showed you, remember that one single green dot for the last 20 days? It was positive, and that was the developed markets. And then on the fixed income, the government or corporate bonds, government bonds are more favorable than corporate bonds. Both are down quite a bit, but the government bonds are down less. And it's hard to imagine. And then short-term versus long-term on the bond prices, one that's down the least is short-term. The U.S. versus the world. This is where they compare the U.S., meaning SPY, the S&P 500, relative to ETFs that represent other countries. Each country has its own ETF, measured in the second column. And you can see all of the countries in Latin America, Asia, Europe, etc. And they are nearly all but 3 are outperforming the S&P 500. So the money is going to other parts of the world, whether it be South America or Europe or Asia, Australia, wherever it's going, all of those are outperforming the U.S. in the last week, the last month, and the last quarter. A significant change. Gold and silver. As of Friday, gold, as I showed you in a previous chart, gold has had a short-term move up. It's up 2.1% as of Friday, and silver up 2% from the previous week. I wanted to share this with you. I got this courtesy of Don Creech. Have a history teacher explain this to you. The similarities between Abraham Lincoln and John F. Kennedy. Abraham Lincoln was elected to Congress in 1846. John F. Kennedy was elected to Congress in 1946. Abraham Lincoln was elected president in 1860. John F. Kennedy was elected president in 1960. Both were particularly concerned with civil rights. Both wives lost a child while living in the White House. Both presidents were shot on a Friday. Both presidents were shot in the head. Now it really gets weird. Lincoln's secretary was named Kennedy. Kennedy's secretary was named Lincoln. Both were assassinated by Southerners. Both were succeeded by Southerners named Johnson. Andrew Johnson, who succeeded Lincoln, was born in 1808, and Lyndon Johnson, who succeeded Kennedy, was born in 1908. John Wilkes Booth, who assassinated Lincoln, was born in 1839. Lee Harvey Oswald, who assassinated Kennedy, was born in 1939. Both assassins were known by their three names. Both names are composed of 15 letters. Now hang on to your seat. Lincoln was shot at the theater named Ford, and Kennedy was shot in a car called Lincoln, made by Ford. Booth and Oswald were assassinated before their trials. And here's the kicker. A week before Lincoln was shot, he was in Monroe, Maryland. A week before Kennedy was shot, he was with Marilyn Monroe. And Lincoln was shot in a theater, and the assassin ran to a warehouse. Kennedy was shot from a warehouse, and the assassin ran to a theater. I thought you would find that interesting. I'll put a copy of it in the comment section below if you want to copy it. Thank you for watching. Leave questions and comments in the comment section below. I answer all questions. Thank you.